travel isn't just about destinations, it's about the people you meet, the cultures you immerse yourself in, the stories you carry home. I'm Relebogile Mabocha, and on my travel feature, I take you on a journey beyond the guidebook. Each week, I connect with fellow travelers, insiders, and storytellers to bring you the heart of every place. Whether it's a hidden gem right here in South Africa or a dream destination abroad. Join me as we travel through conversations, memories, and inspiration. Listen wherever you get your podcasts.
The Money Show.
Personal Finance with Warren Ingram.
This personal finance feature is brought to you by Indware Risk Services, because the right insurance starts with a conversation. It starts with Hello Indware. Well, Warren Ingram, as you know, is a certified financial planner at Galileo Capital. Tonight, we're talking about financial emergencies and how to prepare for them. Warren, good evening. I'm not going to ask what inspired this tonight, but a financial emergency is something that's inevitable and it will happen to all of us.
Absolutely right, Stephen. And I think it's, we just have to look around the world and see that, financial emergency can happen to us. It can literally fall out the sky in some instances. And if we're not prepared, the problem with a financial emergency is it doesn't really hang around going, I'll wait for you until you're ready. It just happens, and very often happens when you're least prepared and least able to deal with them. So tonight we're talking about taking the steps to fix that.
I've always found that actually the worst times are not when one thing happens. It's usually in threes. But, the geyser goes, then there's a bumper bashing, and then there's something else. The roof starts leaking or something. And that's actually, you don't realize it at the time, but it's the three of them together that constitute the emergency because they all cost money.
It sounds to me like you're a new homeowner going through some financial trauma there, Stephen. I hear it. I hear the pain. It's real, and you're right. We can probably deal with one or two issues, maybe just from our own resources. But at the moment, it's a bigger item, so something that really derails us, or an accumulation of small items, then we're in a position where we're going to either have to take debt, or we're going to, and that debt that we're going to be forced to take at that moment in time is what's available to us very quickly. And debt that's available to you at very short notice is usually the most expensive form of debt you can find. And so we're in a position where we either have to do that, or we have to sell things that are valuable to us. And the things that you can sell that are most valuable are the ones that can be traded very quickly are probably the things you really shouldn't be selling. So you're right. We have this big issue that just sort of arrives on us, and it happens to us. And inevitably, when you talk to people sort of later in their careers or potentially in retirement, they'll tell you these kinds of things just crept up on them. And then all of a sudden, it was a series of small little problems that just compounded and got them really stuck. And that's the thing we don't want to happen to people.
Okay, so an emergency fund is the obvious answer. Most of us have some form of debt, and we're putting any money that we have extra into that. How then should you start an emergency fund at the same time?
I think maybe it's a case of taking a small step in one direction and then pivoting and fixing the debt for a while, and then going back to the emergency fund. So for example, I think an ideal size emergency fund is somewhere around 3 to 6 months worth of your expenses. And that for most of us would constitute the kind of biggest financial emergency that we would need to fund from our own resources. But if you're sitting there with especially short-term debt like credit cards, personal loans, overdrafts, those kinds of things, and no emergency fund, then it's obvious that you need to spend as much of your money as you possibly can on getting that debt paid down as quickly as you can. But at the same time, you've still got no powder left dry to take care of the emergency that might be happening. So the answer then is make sure that you're always paying off the debts, those debts, at least the minimum amount that you're required to pay on a monthly basis. But then start building up the emergency fund. My suggestion, depending on how big your expenses are, is maybe just set a target. Go for the first 10,000 Rand of what your emergency fund should be. So let's say you spend 20,000 Rand a month. then you would know that your emergency fund should be somewhere around 20 times 3. So what's that? 60,000 to 120,000 is really what you're aiming for, but you're not going to get there very quickly. So at the start, just build up that emergency fund of 10,000 Rand. Once you've got that, you've got some peace of mind that if something goes wrong, and it's not a huge amount, at least you've got some money available to take care of a smaller emergency. And then you go flat out on knocking your short-term debts as fast as you can. And I think that the trick there is it might take you 2 or 3 years to get rid of those short-term debts. So at least being able to let that emergency fund sit idle and maybe grow a little bit while you're doing that should give you some sort of protection.
We do need to discuss emergency. Kaiser Chiefs actually getting into the final of something and tickets being available might be an emergency. You do need to think about that quite carefully.
I think quite a few people were having conversations with themselves or their spouses when they suddenly realized that South Africa has a fairly decent chance of beating Australia in the World Test Championship and figuring out whether they could get plane tickets overnight to get to watch the last couple of days, and that unfortunately doesn't constitute an emergency. So to me, an emergency, you categorize it in a couple of ways. One, it must be something that is dramatically affecting your and your loved ones' lives. So in other words, if you need a car to get to work every day and your car's broken down, I would say that's an emergency. And equally, I guess an obvious one would be a medical crisis where potentially your medical aid is not covering an important medical cost, or someone's sick in your family and you need to look after them. Clearly, that's an emergency. And then kind of much more mundane would be, the geyser bursts at home and you might have insurance, but your insurance company says, look, we're not doing anything until you pay the excess, the initial part of the claim. And your house can't function, it can't be repaired without that initial excess. So for me, those are real emergencies. And understanding that there are things that are urgent and important. A predictable event is not an emergency. In other words, if you know that you might need to replace your car in 2 or 3 years' time, that's very important. It's something you should start to plan for and make a financial commitment every month to deal with that. But that's not why you have an emergency fund. And the reality is, if you use your emergency fund to look after buying a new car, most likely the very next day after you've committed all that money and bought the new car is when the geyser bursts and you've got no financial resources to pay for the excess. Those are the kinds of situations that you have the emergency fund for. So important, urgent, and not predictable. I know it sounds really basic, but when we're dealing with this stuff, we need to give ourselves some ground rules for what we're planning for and deal with those in a systematic way in the middle of a crisis. Unfortunately, none of us make great decisions when we're under financial or other stress.
No, of course. I mean, and part of this is also a sort of spending plan. You need to know where money is going now, right? So you kind of know what an emergency would be.
True, and equally, I mean, it's an assumption, but I think it's probably a safe one. If you're listening and you're saying to yourself, well, I've got quite a bit of debt and I've got no emergency fund, no real plan for what to do if something goes wrong from here, then there's probably a fairly safe assumption that you don't really know where your money's going every month. And if you have to start to understand that, it starts to help you make better decisions with your money. So step one in a situation like this is track what you're spending. Actually look at your bank statements every month for the last few months and see where the money is going. I think understanding where it's gone allows you to start making some better decisions. And note, I'm not saying you can't spend money. I'm not saying that you have to now live like a hermit on a hill and have no fun and no enjoyment in life. That's not the deal. But it's just getting a really good grip on what's actually going on with the way that you spend. And then you can start to make some informed decisions to say, what's important to me, for example, might be a weekend away every now and then. So I'm not going to compromise on that. But I realize I'm spending 300 or 400 rand a day on, very nice coffees all around town. And actually I can make a really nice coffee at home and put it in a nice thermos flask or whatever it is, a travel cup, and travel with nice coffee. I don't need to spend the money on that. And very quickly, by just looking at what's happened over the last few months of your expenses, you start to figure out where your money is being wasted and where it's really adding value in life. I think really important to me, Stephen, is if you're in a relationship, your best chance of success is not doing this in isolation. It has to be something that you do as a team. Having talked to couples for many decades, the couples that achieve financial freedom and that have some kind of financial success, the one thing they do is that they plan together. I'm not saying that one person's in control of the other person's money. It's not a control issue. It's about joint goals and then holding each other accountable and helping each other when times get tough and someone's finding it a bit depressing because they haven't had to be able to buy that extra coffee that they really wanted or whatever the deal is. But do this together and don't do it in isolation. It doesn't help.
Well, I was going to say, relationships, you really need to have that conversation. Okay, so if you're in a position where something happens, you had to get the car fixed, the cost is huge, and you can't actually repay it now, what should you do?
I think it's kind of a terrifying situation. I think a lot of people find themselves in a position where they're terrified to open the banking app. They certainly don't look at the emails from the banks and the people to whom they owe money, because what they know is that they can't make a plan to deal with that. And so they ignore it. And the one thing you have to know about money is when you have it and it starts to grow, it compounds in your favor. But when you owe money, it's growing against you. It's compounding against you at a rapid rate, and it never goes away. The one thing you cannot do in a situation like this is ignore the money problems, because they're just simply, you can't wish them away. And so I think the thing here is don't be passive. Don't sit back and just dread what's going on. Rather take some form of action. And let's talk about sort of really tough situations that people find themselves in. One of them is they get to a situation where they cannot afford to pay the home loan, their mortgage on a monthly basis. Now, if you're in a position like that and you're not engaging with the bank and you're not taking action to do something about it, what happens is eventually, there's quite a long legal process, but eventually what will happen is the bank will take your house. They will repossess your house and they will put it up for auction and they will sell it. And their interest is to get their money back. Their interest is not to make sure that you're in the best possible position you could be. So if you're faced with this really tough situation, don't wait. Take control and actually sell the house yourself. Get the very best price you can and then settle the debts with the bank. That means you have to find a new place to live. But either way, you're going to be stuck in that situation. If you wait, the bank's going to take your house and then you're going to need to find a place to live, possibly with a lot less money than you would have had. So rather settle your debts in that situation, take control and do something about it. The same applies to a car. If you've taken a car on an installment sale and you're not able to pay, don't let the bank repossess it and then sell it. They sell those cars in auctions, and auctions are never where you're going to get the best price. I mean, there might be great auction sites, but if you take control, you look for a really good buyer, you take care of the car and sell it, you're going to get the best possible price you can, and then settle the outstanding with the bank. In all of these situations, we're not talking about your dream scenarios here. What we're talking about is really tough choices. And if you sit back, those tough choices get made for you. And unfortunately, they're going to be much more expensive for you than you taking the decision.
Okay, yeah, I mean, it's always so often in life, isn't it? You have to actually face it head on. So absolutely. Personal finance this evening with Warren Ingram. We have a question from Jonathan. Hi, what are actively managed ETFs and should I consider buying them? That's from Jonathan. Well, we'll have an answer for that for you in just a moment.
The Money Show.
Personal finance with Warren Ingram.
Warren, of course, is a certified financial planner at Galileo Capital. And Warren, we had a question from Jonathan. What are actively managed ETFs and should I consider buying them?
So I think we've got to do a little bit of de-jargoning here and a little bit of history to answer the question for Jonathan. So when we're talking about something like this, what we're talking about is a type of investment. And originally, when they came to South Africa, ETFs were revolutionary. They had been around for a while overseas, but what happened was we found a share that was listed on the stock exchange that allowed us to buy the top 40 shares in South Africa. And that was the first exchange traded fund. So that's what it stands for. ETF is exchange traded fund. And it was very innovative because instead of me having to go and buy all 40 shares at once and paying huge amounts of brokerage and all the admin involved in trying to track the 40 biggest companies on the JSE, I could simply buy one thing, and that one thing would actually end up owning those 40 shares in proportion and allow me to get the benefit of the 40 biggest companies going up, hopefully, or even going down, and all the dividends that they pay, et cetera, et cetera. So it was a revolutionary form of investment. The idea at the time was exchange traded funds would be a lot cheaper than for example, their unit trust competitors, which were at the time a lot more expensive than an exchange traded fund. And I could transact in them in relatively small amounts. I could open a stockbroking account and buy an exchange traded fund for probably 50 or 100 or 200 rand, or whatever the amount was, without any ongoing contract. I could do what I wanted. And anything like that, which is innovative, that actually attracts huge investor interest, will attract a lot of product provider interest. And that's what we found, was suddenly a bunch of product providers started to launch more and more forms of exchange traded funds. And all the time, we had the unit trust industry looking at this with relative, I guess initially probably a little bit of bemusement, but after a while, a bit of fear and concern, because a lot of the time, these exchange traded funds were taking money away from unit trusts, and so unit trusts started to get a bit cheaper. And their big competitive advantage was you could buy unit trusts where you would have a fund manager deciding what to buy and sell within that fund, and the idea being that they would do better than the stock market, or they could have a balanced fund where there was some cash, some bonds, some property, some shares, etc., and they could mix and match those assets in a way that they thought would be in your interests and according to some kind of a long-term benchmark. And that was something that you couldn't get in an exchange-traded fund. So, of course, the industry doesn't stand still. So what they did, the exchange-traded fund industry, was look at this and say, well, hang on, why don't we launch our version of let's say a balanced unit trust or an actively managed unit trust in the form of an exchange traded fund? And that's where we are today. I think somewhere around 2022, we saw the first ones being approved in South Africa. I think they're listed in 23. There's certainly more than 20 of them now, and I think it's a growing part of the industry. So the answer to Jonathan's question is, that they're interesting to look at. They might have some cost benefits, but it's going to, I think what matters really is not whether you should buy them as a whole class of investment, but what you're actually looking for. So if you're looking for an actively managed investment and you want to trade in a very small amount and you want to own it via a stockbroking account, then perhaps an actively managed ETF is a good idea for you. But if you want to own it inside a retirement fund or something like that, then you might want to look at the unit trust. So unfortunately, the industry has made a lot of complexity now out of what used to be very simple investments. And so it's going to be tricky for you, Jonathan, to look at this and say, yes, the answer is I should, or no, the answer is I shouldn't. Unfortunately, I'm going to have to sit on the fence a little bit on this one and say it's really going to depend on your needs. You need to do your homework on the costs. With an exchange traded fund, you buy them, so you're paying a transaction fee, and when you sell them, you're paying a transaction fee. So those are different to a unit trust where you don't pay transaction fees. But the exchange traded fund might be a little bit cheaper on an annual basis with asset management fees relative to the unit trust. So you will need to do your homework on this. And I suspect for larger investors, so people that are trading in amounts of hundreds of thousands, they might find find a preference for the unit trusts, whereas smaller investors might find a preference for exchange traded funds. But I think it's going to be many sizes of shoe fitting, many kinds of investors. We're not going to find one answer for everybody in this one.
It's interesting to see, and I mean, you make such an interesting point about how complex the industry has become, and maybe that doesn't really help us. Let's just very quickly wrap up the sort of what to do in a financial jam. We've got a minute left, but your point, it really struck me about how important it is to take action. I mean, that's kind of something that you really have to do. You've got to take one small step and follow it up with another, and actually, one day you'll look behind you and see how much progress you've made.
Exactly right. So those, that compounding problem with money can be resolved. You can allow compounding to work for you. So if you're listening to this and you're terrified and you're stuck, the way to unstick yourself from this situation is take one action, do one thing, go and draw your bank statements online and just start to look at what you're doing. That's the thing you do today. Tomorrow, look at what you can cut. The day after, start to cut. That's maybe the first 3 steps you can follow. And then talk to a trusted person that you know that can help you look at these things a bit more objectively. But don't just sit there and let it go against you. It's a terrible place to be.
Warren Ingram, thank you so much. Co-founder of Galileo Capital and, of course, with personal finance this evening, a certified financial planner.